Hello and welcome to S&P Global Ratings Fixed Income in 15, a 15-minute chat with a market voice and an S&P executive. My name is Joe Cass. I head up market outreach in the UK. Today I'm joined by Tom Keene, co-anchor of Bloomberg Surveillance. Alongside Tom is Beth-Ann Bovino, Managing Director and US Chief Economist at S&P Global Ratings. Thank you very much for joining me today, Tom and Beth-Ann.
Great to be here.
It's great to be with you.
So just before we start, a very quick reminder that the views of the external guests on the show today are their views alone and do not represent the views of S&P Global Ratings. Okay, Tom, let's kick off with a question for you. You're meeting senior investors and market participants every day. What are they telling you about the buildup of US debt? And do you have any personal thoughts on the matter?
Well, the buildup of debt is there. There's a distinction, as Beth-Ann knows, of the debt and the deficit. But what I really would point out is how they've immediately linked in billions and trillions of dollars of stimulus into the number one worry into the end of 2021, which is wither inflation. I know that's something that Beth is completely focused on. What I see, the end of April and into May is this huge assumption of rising interest rates in some form or another, in a very quiet, lonely group saying, maybe not.
Sure. So Beth-Ann, what's our house view of the US debt buildup and what are the potential longer term ramifications for credit markets?
Well, what we have seen certainly is the both US government debt buildup, largely tied to the back-to-back stimulus packages that in some ways we see were a bridge to the other side. We see the buildup in that debt that applied to the stimulus was something that was necessary to see the U.S. economy back to health. Now, we do recognize that the debt levels are significantly high, but we do see that that's a medium-term question, something that the U.S. government will need to address. In terms of the stimulus and the impact on inflation that markets are concerned about, we do expect to see a near-term significant boost in inflation over the second quarter and into the third and fourth. But we see that as temporary. We see that as something that's tied to the base effect, meaning inflation was very low last year, so expect a bounce this year. But we do think that long-term trends that really kind of had inflation levels at below the Fed's target will kick in. Globalization, for example, the gig economy, they haven't gone away. And that's why we see long-term inflation expectations, something key to watch, and they remain very low.
Thank you. Great. Tom, I'd like to talk a little bit more with you about rates. So where are the potential areas of stability and also instability if and when rates were to move higher?
Well, that's been predicted here now for 15 or 20 years. I remember a chart that Credit Suisse had years ago with Dominic Constam, where it would, and Beth remembers this, there was a tail distribution of the guesstimate or the expectations of what interest rates will do. And basically you could go wrong, 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 and on we went, misjudging the when of higher interest rates. And with that, the worries about instability. We've dampened down. We've done it over the great disinflation. There have been some unstable moments. We all remember the taper tantrum of a couple of years ago, but there's almost a leadenness to where we are now in rates. And once again, a massive worry about high inflation. Full disclosure, I'm in the camp with Beth that it is transitory. That's the word du jour. And I just don't observe out there, particularly on wages, the inflation. Beth, the number one thing to me in terms of stability and instability and the leadenness of the American system is the monopsonistic tendencies out there. I'm not sure what the wage negotiation power is that gets you to that fever, that gets you to Joe's instabilities.
I would like to jump in here and comment to what Tom had said, is that when I talked about inflation expectations, long-term inflation expectations, that's very anchored to, unfortunately, too low levels. One of the factors is globalization. tied to buyers being able to purchase anything around the world, mainly products, but now it's services. And that means that question in terms of those wage, that wage earners don't necessarily have bargaining power. It's highlighted even more because of the globalization of services now as well.
Absolutely. Beth-Ann, S&P Global Ratings have released the US Economic Outlook for Q2 2021 with the subheading, Let the Good Times Roll. So with that in mind, can you let us know some of the key takeaways from the publication?
Sure. A lot of that, we have seen several factors since our earlier forecast. The forecast that we have for GDP this year is forget that one, is 6.5%. That's a 37-year high for growth in the United States. And it follows with a very nice reading in 2022 of a little over 3%. This is a big upward revision in our forecast from where we were in December. A big factor was because of that $1.9 trillion stimulus that is now in place. But other factors, other variables also play in. The vaccination rollout is much faster than we earlier thought. It's moving at a much quicker pace, meaning that the U.S. may reach herd immunity sooner. That means that we're seeing more reopenings across the United States. More reopenings means more jobs, more spending, and more activity going forward. All good news. Indeed, we have now a risk of recession for the United States between 10 to 15%. That's the lowest risk we've had over the next 12 months, the lowest risk we've had in 6 years. And I would add, though, that while this is all good news, I do want to point out that there are still some scars left from the pandemic, and in particular the jobs market. The unemployment rate has improved. It's now 6%, all good news. And we saw some really breadth in terms of who was getting jobs. However, when you adjust it for those people who left the workforce and those people who may have been misclassified by the Bureau of Labor Statistics, that unemployment rate is closer to 9%, meaning that there's a lot of people out there that are still hurting. A lot of those people are long-term unemployed, and that's going to take a long time to get them back. That hurts them, their pocketbooks, as well as the economy's productivity going forward.
Absolutely. Tom, over time, investors traditionally will change the asset mix within a target date fund, the glide path. So what have you heard from investors about the potential future of this glide path?
Well, I associate the phrase glide path with Peter Orszag out of LSE, and it's one combination of mathematics and, we talk, as Beth knows, we talk about reaction functions within central banking. To me, the glide path is somewhat about stability, but it's the rate of change and the rate of change and rate of change. I have never seen, I know Beth could go on this all day, the mystery of the x-axis. You got a y-axis, which is what the media talks about all the time, and the adults are down on the x-axis, like all of Standard & Poor's, looking at the when of it and the what of it, the short, the medium, the long term. And we've never ever had a greater mystery over where we are now and the why of it. So we don't know those many glide paths. I feel that very, very strongly. I'm completely focused on this earnings season. You talk about S&P 5-star outlook. I'm completely focused on this earnings season to get any kind of whispers from C-class officers about what their glide path is. And I don't think it is. I love Beth's idea of 6.5 down to 3-ish. I look at that almost as a 24-month guesstimate on the economy because this time is so unusual.
Sure. So now we're going to move on to some non-market related questions. So Tom, I'll start with you. You're meeting with dozens of interesting individuals from government, finance, tech, academia, every week, every day. So which individuals stand out to you as kind of the most insightful, and which guests are the most entertaining?
Well, there are two separate ones right now in the pandemic. We decided in February of last year that we were going to talk to medical pros and lose the gossip. And my first interview on the pandemic was with Dr. Blenheim of Mount Sinai, who literally brought actual x-rays from Wuhan into the TV studio with him, which was amazing. And he predicted so much of the damage that this virus does. But I would say without question in the last year, it's been the medical people. We've talked to centered around Johns Hopkins University and frankly in London, Imperial College and UCL. I'll be speaking to UCL, I think, in 2 weeks. But other than the courage of all those people as they deal with the pandemic, the most interesting thing to me, and particularly in Beth's world of economics, is what are we going to do in the next year about the combination of the trade deficit and the fiscal deficit? And we bundle those in, Joe, into the twin deficit. In some measurements now, that's out 5 or 6 standard deviations, which we've really never confronted before except for war.
Absolutely. Okay, Beth-Ann, outside of work, how have you been spending any free time during the kind of lockdown quarantine period?
Well, I have to say, listening to Tom, what a wonderful job to be able to listen to and speak with all these outside experts. I honestly wish I was a fly on the wall for some of those. I guess we do have the opportunity to listen to your studio, to your interviews. It sounds very exciting. In terms of what I have done over the last, basically during quarantine, I guess we finally came out of that. A lot of it was staying at home. The nesting instinct, of course, we had it at my house as well. I picked up a habit. I picked up piano. I'm a beginner, just like my 5-year-old son. But I'm not giving it up. It's amazing what you can do when you don't go out much. That's been pretty exciting.
Okay, and I'm giving Beth the surveillance warning. We, as a cardinal rule, anyone we interview at a home with a musical instrument in the background, they have to play it out. We got some real concerts.
I do a mean twinkle twinkle.
No, that's really, really impressive. I mean, we've all dealt with it. And, I think I can speak for Michael Bloomberg that we're just struggling every day, led by the reality of vaccination, to figure out what the future is. And every company's doing this, small, big, different. But to Beth's point about the labor economy in America, there is a huge body of America, Joe, that have not recovered from this. Doesn't matter if they get vaccinated or not, they need support.
Absolutely. On to a slightly different topic. Tom, I'm wearing my bow tie today in honor of your appearance. But with the rise of kind of smart casual, with finance following the tech model, are we going to see the death of all ties in the next kind of 3 to 5 years?
I get asked this a lot, and frankly, particularly in the United Kingdom, there's been, a whole thing about this. I go back and forth. I mean, I'm old enough to tell you who to blame this on. You can blame casual on Kevin Costner in Bull Durham. Kevin Costner shot Bull Durham, and the next day, 2/3 of male America wanted to look like Kevin Costner. So I'm going to blame it on the wonderful actor. But with that said, I think it varies, and I think every story is different. I do take the point, and I see this at Bloomberg worldwide, that everybody dresses better worldwide at Bloomberg than in the New York office. So we Americans are behind.
Excellent. Tom, I see you and your fellow co-host on Bloomberg Surveillance, John Farrow, talk about Tottenham a lot and talk about kind of how Tottenham are doing. So very interested to get your take of what happened with the European Super League, of which Spurs were all set to join.
I feel very strongly the Americans happened. I mean, I know there's some blame to go around in Spain and Italy and the rest, but I think really it's essentially the NFLization of a cultural lodestone for a continent, if you will. It's been a lot of fun. I mean, with John Farrell, I have to do English football. We know at Bloomberg, it is the world sport. I was lectured on that 20 plus years ago by our senior management. I learned it in a hotel room in Hong Kong where I could only turn on 5 soccer games at one moment. So, I picked up an affection for Tottenham. I don't even know how that came about. They've actually contacted me. They're thrilled that we talk about the Tots and, the rest of the league. But this has been a big embarrassment, including seeing JP Morgan having to apologize and others. And to me, it's just, this is something really important, and all this fancy finance we do and the economics and the wonderful credit work that S&P has always been acclaimed for. I should point out that I think the Standard & Poor's 500 index is the oldest, longest series we've got on the Bloomberg. All that's great, but it still comes back to culture. And what these well-meaning owners did, heavily in debt, maybe you guys will rate the debt, but what they did, losing millions and millions of money, was misjudged culture.
I'm actually a West Ham fan. You've heard of them. So if all you guys would have gone to the kind of elite league, it would have made West Ham the biggest club in England by proxy. So I was kind of half hoping it would happen, but alas.
Well, this is interesting, Beth, and let me make just this quickly. Steve Major at HSBC is a diehard West Ham fan, just moving to Hong Kong as they struggle with China and all that. And Steve Major is persistently low interest rate. Beth, why am I interviewing you? Wait, you're interviewing me. Beth, what's the setup that gets Stephen Major, West Ham fan, to a perpetually lower interest rate, pushing against everybody else? How does that happen?
Why is he expecting his forecast is for a very low, and I assume we're talking about the U.S.
U.S. full faith and credit 10-year yield just is not going to go up, and it's going to stay lower. They've got a 1% statistic on the 10-year yield out 12 months or so.
Wow. We all can have our opinions, and this sounds like, this person does as well. I would say that, my take, I can't really speak of what this person, how this person came up to their viewpoint. I can say from us, where we stand, we do see, one factor that would keep interest rates relatively low is the Fed is broadcasting that they don't plan to move. They plan to keep interest rates low, and they're saying now it could very well go to 2024 before they raise rates. Now, and you also have the history. Now, we know that history is not a very good predictor of what happens in the future, but you do have many years of very low inflation, well below the Fed's target of 2%, and with that very, very low interest rates as well. So I suspect that the persistence effect, both on inflation as well as how that feeds into interest rates, is probably why I suspect investors are more sanguine. I would say though, we at S&P Global are expecting interest rates to slowly climb higher. We're not expecting a major jump at this point in time. We do think that the 3 criteria that the Fed has been trying to broadcast across the world, what they're looking for, maximum employment, and not just our usual headlines, but across a dashboard of many indicators, are what they're focused on. So don't just pay attention to that headline unemployment rate. Look at demographics. Second, they want to see inflation get above the 2% point, overheat, I guess you could say, moderately for a little bit of time. So that 2% target is not a hard fast anymore. And third, they would like to see inflation kind of be anchored around 2% before they move. That to me says the Fed is going to wait a little longer. Inflation rate is also going to be before they move. And that to me suggests that the interest rates, while we could see a near-term pickup because of market concerns, I think that it'll be a slow glide up. Higher than what this person thinks, but again, a slow glide up.
Fantastic. Thank you very much, Beth-Ann. So there's a couple of questions left. A bit of a deep question. This question goes to both of you. So looking at kind of significant global topics like the climate emergency, artificial intelligence, or space travel, or social media, or anything really, on a personal level, what excites or scares you about the future of humanity? And Tom, we'll start this one with you, if that's okay.
Well, it's a 70,000-foot question, I would say, and it's just because of the various offspring. I'm beyond concerned about how we're educating our children, even starting at the youngest level. Jeff Sachs at Columbia, I know Beth, I'm sure, studied with Professor Sachs at Columbia when she took her PhD. I'm sorry. What's so important here, all of what we see from Jeff Sachs and others, is just this 10 or 20 year gap where we really haven't educated our children. I think it's absolutely front and center. I think the Minneapolis Fed has really provided younger children leadership on this, and it's off the radar right now, but to me, it's just the absolute number one thing.
And Beth-Ann, same question to you.
Well, I could add a little bit to what Tom had said, because that also is definitely on my radar and one of my big concerns, particularly after coming out of the I will add more of my own thoughts too, but coming out of the pandemic and basically the lockdown, where many children had to work by Zoom, had to be schooled through Zoom. And we know that, depending on your income level, where you are in the income bracket, really showed how you could excel. So lower income families, those that would be often tied to minorities, were likely struggling. So that means a number of young kids were left behind, and unfortunately, it seems that it spreads the education gap between the haves and the have-nots. That's a big concern for me. But another thing that I am concerned about is something that we saw. Look, I love social media. I love the fact that we can communicate with each other and other people across the world, that we get individual opinions from all different walks of life. But my concern is that the misinformation, the disinformation that is out there, and that to me can sort of create it can cloud the judgment and it clouds basically the information from the news. It becomes the news, and that does worry me going forward.
Yeah, two very valid points. So Tom, last question goes to you. So on this podcast, Fixed Income in 15, I usually interview leaders, influential individuals from the world of finance and economics. So who would you recommend I ask to be a guest on a future episode of the show?
Oh, I'd say Fabozzi, but I think there's so many people, particularly around fixed income. It was a really interesting guy, and he came up the other day. We were talking with Mark Carney, and first of all, Governor Carney would be fabulous to have in the program. He's arguably our most eclectic thinker within economics and public policy. But we were talking about the heritage of San Diego, and to have James Hamilton on of San Diego, who owns time series analysis. He's a really, really interesting guy. With the loss of Ed Lazier at Stanford on labor economics, I think just off the top of my head, James Hamilton would be a really interesting guy to have on.
Excellent. Thank you for that recommendation. So my thanks to Tom, my thanks to Beth-Ann, both for your time today. It's been fantastic to hear your perspectives. So for anyone watching and listening, see you next time on Fixed Income in 15.